Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for March 2021. Let's take a look at key highlights of February 2021. Economy made a comeback in expansion zone as third quarter of financial year 2021 witnessed positive year-on-year growth in nominal as well as real GDP numbers for the first time in current fiscal year. Improvement in investments was the most important contributor to the revival of GDP, while other components like private consumption are yet to catch up. Agriculture and manufacturing sector lead the recovery, while service sector is still lagging. However, the recovery in GDP numbers couldn't enthuse FII inflows in the first week of March. This can be attributed to recent rise in the US bond yields, which can play a spoilsport in the emerging markets bull run. Indian equity market continued its positive momentum in the last month, wherein mid and small cap indices significantly outperformed Nifty 50. FII inflow remained strong due to investment-oriented budget announcements, sustained global as well as local liquidity, and positivity due to initiation of vaccination across the globe. Valuation indicators like market cap to GDP ratio have shot up reasonably above their long-term average. However, fundamental elements like earnings growth and profitability, which were missing in last 2 to 3 quarters, have now started to reflect in the market. Profitability of Indian corporates has substantially improved due to prudent cost management and low input costs. Moderation of yield gap between equity and debt, as well as rise in US interest rates, may cause corrections in Indian equity markets. Such dips can be used to further increase equity allocation in portfolios. We continue with marginal overweight stance on equities based on respective risk profiles. The longer end of the yield curve came under pressure immediately after announcement of government's borrowing program. Bear steepening due to unabated rise in the yields has resulted in Indian yield curve becoming steeper than ever. Inflation has further eased off in January and is now much below the upper limit of inflation target, aided by lower food price inflation and easing supply chain dynamics. A lower inflation will make it convenient for RBI to maintain low interest rates and status quo on accommodative stance. Investment opportunities in high-quality credit have significantly diminished. High-yield credit can be considered subject to appropriate due diligence. The credit spreads can be expected to cool off as systemic risks will decrease with recovery in economy. Though inflation rates have cooled off recently, the longer end of the curve may remain under pressure due to massive borrowing program by the government. Core allocation to high-quality credit with diversification across yield-oriented HTM solutions is advisable. Dislocations in credit spreads should be opportunistically used, subject to proper due diligence.